Hey guys, it's Cameron here with Emerson Property Management. Every week, I bring you tools, tactics, strategies, lessons I've learned, things how we built up a sizable own portfolio in about 2 years and now manage that portfolio. Today, guys, I want to talk about something that gets floated around a lot, especially if you're a bookkeeper or accountant or you talk to them. They always this time of year or right after tax season, they bring up depreciation. So if you've been in this game a while, tax benefits are one of the huge things that real estate can offer. You can't really get that in stocks and other things. So depreciation is extremely lucrative, especially if you have a high W-2. But I want to talk about why it's not all the cat's meow, as they say, because it gets floated around a lot and a lot of accountants want you to do it. So I want to talk through that, the pros, the cons, give you the real honest view from somebody that uses depreciation a lot across my entire rental portfolio. And you should as well if you have a rental portfolio, but shouldn't be the guiding light. Don't let the depreciation tail wag the investment dog, as they say. So before I get into that, if you guys like this stuff, if you find it valuable, like it, share, subscribe. We appreciate that. Helps us out. Okay, let's get into this thing. So yes, I'm sure you guys were looking forward to my handy dandy whiteboard here. First and foremost, so depreciation in residential uses. So if you get into bigger commercial properties, 5 units and above, you're starting to look at a 39-year depreciation. But for residential, for the purposes we're going to be talking about, especially single-family homes, the depreciation is 27 and a half years. Now, what does that mean, Cameron? So depreciation, think about it as the government giving you a break because you have to maintain the property. This is something that deteriorates or wears down or depreciates, whereas appreciation is when the property value goes up. Depreciation is the value of the stuff eroding away. So you strip out land. Land is not included in depreciation. So if you buy a vacant lot, you get zero depreciation. There's no improvements on the property, you get zero. So what this 27 and a half year number is if, let's just say, I'm going to use this as an example. Let's just say you buy a property, you take out the land and the improvements value $275,000. So 275 divided by 27 and a half would be $10,000 a year that you would get to deduct. Now, let me say that again. You get to depreciate. I'll explain how you use that against your taxes and whatnot, but that's the big thing. You strip out the land, the improved value divided by 27 and a half years. Now, we're going to talk just momentarily about the accelerated depreciation. So you've probably heard of these cost segregation studies. These are a big thing thrown around in the real estate world, and a lot of fancy accountants want people to do cost seg because they think that you'll get a bunch of tax deductions early on. So instead of taking it out 27 and a half years, like most residential properties, you can depreciate HVAC systems that only last 10 or 15 years, flooring that might only last 5 or 10 years. You take out some of those mechanicals, and instead of having them at 27 and a half, you can more quickly depreciate them over 5, 7, 10, 12, 15 years. So that's how they're able to take this number, 27 and a half, and get you a higher depreciation number each year. So I hope that makes sense. If not, pause, go look it up online, do some fancy graphs and charts and whatnot, but they'll explain that to you. It's taking it down, if this number is smaller than the depreciation number is larger. Okay, second piece here. Depreciation is not equal in expense. So what does that mean, Cameron? The depreciation is a number that you're allowed to deduct from your taxable income or from the rental income that you bring into the property. However, and the big differentiation between that and a write-off or an expense. So property taxes, insurance. I've got another video somewhere on taxes and all the itemizations per the IRS guidelines for your Schedule E, which is for real estate. And that will explain all those insurance, legal and professional fees, repairs, cleaning and maintenance, So all those expenses you're allowed to deduct from your rental income. You're allowed to do that for depreciation as well. However, you have to pay back depreciation. So that gets into my last piece here, depreciation recapture. And I have a little note in here about tax at 25%. So unlike an expense, we're not going to talk about an improvement, a larger improvement. I mean, I can get into that, but let's just say an expense. You cut a check for your property taxes that year. You cut a check for insurance. Those are directly deductible in that year that you cut that check against your income. So if you have $5,000 in property taxes that you paid on a property and you made $10,000 in rental income, you can bring that down to $5,000 in rental income that you have to pay taxes on. Again, I'm using broad generalities here. Same thing with insurance, repairs, cleaning and maintenance, any legal and professional fees, any property management fees, any of that you can deduct in the year. At the end of the day, you'll then get a depreciation number. Your accountant or tax advisor will do this for you. They'll give you the depreciation number. $2,675 a year is what you're allowed to depreciate. So once you have your final number of all your expenses, then that final number, you get to deduct the depreciation. So again, let's just use some real even numbers. Remember when I said $275,000 house? That's the improved value of the property you bought. Divided by 27.5, that will be $10,000 a year. $10,000 a year is what you're able to deduct. So if after all your expenses, your insurance, your property taxes, your management fees, all that stuff, you have a $10,000 net operating income left or net income left, you will get to depreciate or take off your depreciation of $10,000, which means you have a zero tax liability, no dollars owed in taxes, no taxable income per se. So that's what everybody loves. Oh my gosh, I would have paid taxes on that $10,000, but I got to use my depreciation and reduce my taxable income. However, unlike all the property tax and insurance, when you go to sell that property, you are going to have to do something called depreciation recapture, which means all these expenses that you got to, or all these tax deductions that you got every year for the depreciation. So again, let's use our example of $10,000. If you use that for 5 years, that would be $50,000 in deductions that you received or depreciation that you got to write off. That then you have to pay back when you sell the property. Now, something cool or something that an accountant might tell you or bean counter is, well, Cameron, that's only up to a maximum of 25%. That's the most you're going to pay on your depreciation recapture. Now, for all you tax advisors, accountants out there, double check me on this, but I'm pretty sure this is correct. So they'll say, well, at least you're only going to pay a maximum of 25%. Well, I have pulled up over here the federal tax guidelines or federal tax rates for 2024 for this year. And you have to be making, as a single individual, between 200 and 250 grand as a single person to be above 25%. You have to be, if you're married filing jointly, you need to make between 400 and 500 grand to be above the 25%. So if you make less than 390,000, let's just say 400 grand as a married couple, you're below the 24% bracket. You're not even going to get close to this 25%. So, and as a single person for that same, it's 190,000. If you make less than 190 grand or between 100 and 190, you're only in the 24% bracket. So you're not even in this 25% bracket. So what does all this mean, Cameron? Well, again, this is a great thing that I use across my entire portfolio. I paid, I think, $300 in taxes last year for 2023 because I'm able to write off or deduct a lot of the depreciation. However, some people talk about it as a magic bullet. Do the depreciation on this, do the accelerated depreciation, do a cost seg, and you'll wipe out all your taxes. But what happens is then over the next year, 2, 3, 4, 5, you're building up. Yeah, you're getting to reduce your income now, but you're just kicking that can down the road. So when you do sell the property, or let's just say you do a cost seg and you get a bunch of stuff at 5 to 7 years, after that 5th and 7th year or 5th, 6th, 7th year, you are then going to see your depreciation number go way down. So then it's one of those like self-fulfilling prophecies where then the accountant comes in and goes, oh my God, we got to have more write-offs this year. We need more write-offs. So now do another cost seg and pay me another $2,500 to do it, or I'm an advisor, so I need you to, do some fancy stuff. A lot of the time, and I don't know why this is, I've seen this in my career, whether it's with vendors, property managers, wholesalers, And all across the board, financial advisors, everybody wants to make it complicated. They want you to try all these new strategies. Fundamentally, investing in real estate hasn't really changed over the years. Fundamentally, just like football or weightlifting or anything, it's like blocking and tackling are the fundamentals. No matter what you want to do, you got to start with the basics. Save, invest, live below your means. These are the things that don't change. And some of these companies come out with stuff or try to make you, there's a strategy that you can use. Now, you got to pay me a lot of money to do it, but it's a strategy that could save you some money. So I guess what I'm getting at is this might be a good strategy for you. I would say it's not. I take depreciation. And here's a little caveat. You need to take depreciation because the government assumes you're taking it either way. So you're going to pay depreciation recapture when you sell that property. So take it. But my point is, do the math. Look at the cost seg. Don't just go do a cost seg and spend $2,000, $3,000, $4,000, $5,000 on it when it's only going to save you $50 in taxes. And it's really not going to help you out because you're just kicking the can down the road to when you sell that property in a few years and have to pay all the taxes back. So I hope that was helpful. If it was, let me know. If it wasn't, let me know, y'all. I see this a lot and I just really wanted to voice my opinion on it. And this is Cameron's opinion. Take it for what it's worth. But I see a lot of people getting fancy with this when at the end of the day, let it ride. Let your straight line depreciation be there. You can always do little improvements, other little repairs or maintenance if you think you're going to have a high income year. But I hope that was helpful. I'll see y'all next week.